Okay, so we spoke about those concepts, and then we got into, let's say we've identified a company that we want to purchase. How we go ahead and figure out the results. And the results are what? What do we want to analyze? If we've identified a company that we want to buy out, what is the key analysis that we're looking for? What are we trying to analyze?
How much are we going to sell it for?
Why? What do we want?
Potential operational efficiency.
Why? Yes.
Which gives the edge in terms of what would be the top line.
For what? You're right.
So in terms of utilizing that operational efficiency and what is the net income.
Yeah. For what results are we looking for?
So we are multiple EBITDA.
For what? Yes.
Valuation.
Yes. Why? You're right. But you're circling around the answer that I'm looking for.
Because let's say if there's a bid of 5x or 6x, we have acquired the company now, we increase the EBITDA.
And what does it do for us as investors?
This is returns.
Yes. What about the returns? Increases the IRR. We want IRR. The LBO analysis is all about the IRR. We want to maximize our returns. How do we maximize our returns? That's the culmination of this. Just like we talked about what impacts earnings per share, accretion, dilution, we're going to figure out what impacts returns. How do you maximize returns? So the first thing we want to do is we want to look at the purchase price. We have to value the company to look at the purchase price. Once we look at the purchase price, then we look at the sources and uses of cash. Right? And the sources and uses of cash, we've dealt with this. The uses is what are we paying for? And oftentimes what we're paying for is a lot more than just the purchase price. Right? We need to consider the obligation of refinancing the existing debt. Under what scenarios? Well, we've talked about this a lot. We want to determine whether the company is public or private. If it's public, we cannot leave the responsibility to the shareholders. We have to be responsible. We have to deal with the debt. And we deal with it by either considering whether we have to pay it down or not. If we don't pay it down, it stays with us. The covenants help us determine it. If the company is private, as an analyst, what's the determining factor? Because you're right up front. The determining factor if the company is private? The multiple, the valuation, right? If you are valuing the company with an EBITDA multiple, then that implies you are considering the total capital of the company, the equity and the debt. If your valuation analysis, if you said I'm going to pay 6 times EBITDA for the business, and that's your purchase price, that includes net debt because that's an enterprise value. So don't add target net debt again. That's my point. And the sources, where's the money coming from? We spent yesterday afternoon talking about all this whole spectrum from bank debt down to equity, least risky, most risky, and the in-between. We talked about high yield, paid-in-kind securities. We'll model them out. Mezzanines, any type of convertible lending. Got it? Okay. And we started to talk about ways to determine how much debt a company can raise. Banks use debt multiples. Investment banking analysts use debt multiples to determine what the implied amount of funding would be. S&P and Moody's use these multiples to determine what a company's credit rating should be. And there are different categories of multiples. We'll go into these in more detail in the model, but here are some examples. This EBIT to interest or EBITDA to interest, this is a coverage multiple. This basically implies, if you think about EBIT or EBITDA as a measure of cash flow, EBIT or EBITDA is a good proxy for cash flow, how many times cash coming in could cover your interest? Or you'd want this to be well over 1. If it's under 1, if the multiple's under 1, that means your cash coming in cannot meet your interest payments. You want well over 1 times EBIT or EBITDA.
That's interest coverage ratio?
Yeah, that's interest coverage ratio. Another, debt to equity or debt to total capital is the percentage of debt that's already on your balance sheet. If you have like 80% debt to total capital, probably going to have a tough time raising more debt than that. This is where you have to go to third-party lenders, high yield, mezzanine, other considerations, everyone we talked about yesterday in the beginning. Another way of looking at credit multiples is debt to EBIT, debt to EBITDA. This is more common that we use in LBOs to determine how much debt you can raise to fund an acquisition. I gave you some examples yesterday. Total debt raised is oftentimes 2.5 to 3 times EBITDA. Maybe if your company has 100,000 EBITDA, you can expect to raise $250,000 to $300,000 in debt. Debt to EBITDA. The perspective here is, again, thinking about EBITDA as a proxy for cash flow, debt to EBITDA, that multiple can imply how many years it could take to pay down your principal balance. If your debt to EBITDA is 4 or 5 times, take 4 or 5 times to pay down your EBITDA balance. Just other ways of looking at these. Okay.
What is debt service coverage ratio? Is it linked to the second one, I think?
No. You mean this one?
Yeah.
No. Debt service coverage is it's EBITDA minus maintenance CapEx. We're going to get into this, but if you want the answer, it's EBITDA minus CapEx divided by interest plus principal payments. It's EBITDA minus CapEx minus taxes divided by interest plus principal payments. We're going to get into this, but that's the answer.
Removing capex.
You asked the question. That's the answer.
Why are you removing capex out of it?
Because it's actually, so these are simple multiples. Debt service coverage is actually kind of a derivative of it. It's just a little bit more narrow. So people say, okay, well, EBITDA is a proxy for cash flow. I think really how much cash you're going to have is EBITDA after you pay taxes, after you pay your CapEx, because those are the major requirements. It's just a narrower version of how much cash you have available. And then they say, okay, well, you want to meet interest payments? Well, debt service coverage, I want to make sure you can meet your interest payments plus the principal that we owe. It's just a more specific. And I'll tell you, and the reason why I'm going to save it, and I'm being very simple here, is because there are hundreds of different ways you can put together these multiples, no matter what you want, no matter what the bank has their own requirements. Even as I'm already saying, from group to group, they have their own table of ratios. These are just the general idea of them. So your question, which is a good one, is an extension of this. You're right, yeah.
It's actually EBITDA over interest plus principal payment. Because capex, if you're removing it, end of the year paying, there is a principal.
You're right here. That's what I said. That.
Yeah.
Interest plus principal. Yeah. Right?
Yeah.
I think we're on the same page. Okay. How do you do it? How do you construct an LBO analysis? Okay. What is the purpose? Well, we know the purpose. I'd like to draw it on the board. So let's say we have a company that we've identified, and we've established a purchase price. Okay, we've done the valuation, built the operating model, DCF, whatever. It's okay, it's $100,000, whatever it is. Step 2, like I mentioned, now we got to figure out, we got to step back and figure out the total uses, purchase price, net debt, fees, right? What do we have to fund? And then the total sources. Which is some combination of debt, debts, and equity. Right? Now what? Step 3, the adjustments. What is our goal here?
Maximize the IRR.
We want to know our return. Our return on what?
Equity.
Equity, the investment. This is what we put in. What's our return over time? There's a couple things we need to do to figure out our return. 1, we need to calculate the exit. Well, before you write that down, a couple things we need to do. Let me give you a high level. The first thing you need to do is you need to calculate the exit. Sorry. What do we base our exit on? Multiple of what? Multiple of EBITDA based on the last year. So we'll need to figure out how many years are you going to expect to hold the company. So let's say it's 5 years. We're going to exit on year 5 EBITDA. You're going to calculate 5 years of EBITDA and then apply a multiple. That's 1. That's how much we're going to sell the company for. Okay? But that's not our return yet, is it? Why not? Why is it not our return? Where is it? Am I trying to trick you? What's missing?
We can check the free cash flow.
Got to pay down the debt. You got to pay down the debt. So what we want to do to figure out how much we're going to get, what our return is, we sell the company. Figure out how much we're going to sell the company for in 5 years. Okay. Once we sell the company, though, that's a multiple of EBITDA. That's an enterprise value. Enterprise value. That we don't get the enterprise value. We have to deal with the debt. Just like we made the seller deal with the debt, we have to deal. We're the seller now. We have to deal with the debt. So we got to figure out how to pay down the debt. Okay. So how are we going to figure that out? I mean, you can build the whole model and do the whole, but without, how do you figure that out? How has the debt changed? This is the debt that's on the business now. You paid it down, replace it with new debt. How has the debt changed over 5 years?
Well, it increases.
Why?
Because you don't pay it out in the first year. So then the interest adds to whatever it's up.
So you're accumulating interest.
Yeah.
That's correct. You're accumulating interest. What else is happening now? I don't know.
Because you are paying the premium on, that's part of it, debt only, because you are raising through debt only.
Yeah, you're raising the debt only. So you got interest. Yep.
You have the new debt.
You have the new debt.
And
Yep.
the principal, the premium payment.
You got the premium payments. You got the interest payments. So the debt's obligations are accumulated. How else is the debt changing? This might be what you're saying, but how else is the debt changing?
The ratio of debt equity will change.
Maybe, but that's an analytical thing. I'm talking physically. It's changing. You've incurred interest. What else is happening? Starting debt, you've incurred interest. What else happens? Part of the strategy. Big part of the strategy.
Then you're paying like some sorts of debt faster than other.
Why?
Because of the return. Like the bank did usually lower term. Probably 5 years. Your high yields, shorter.
I don't know if I understand what you're saying.
Like you sourced a bunch of debts.
Yeah.
And some of them are longer term, some of them are shorter term. So
Yeah.
You have to prioritize which one you have to pay.
Okay. So what I'm trying to say is you're probably overthinking this. You have a debt. Debt's increased because of the obligations. How else has the debt changed? It's increased. Does it increase further? Does it decrease?
It depends.
AJ.
Well, since you have more debt, you would have to pay more interest, which reduces your cash flow put on that. Is that what you're doing?
Yeah, and then what?
And then that makes it so that since you have lots of cash on that, that increases your interest expense, which eventually, going to infinity, reduces your cash flow.
All I'm getting at is that debt gets reduced because you pay it down. Cash debt pay down. Cash debt pay down. Cash debt pay down. You're overcomplicating that. So the debt's increasing because the interest incurred, and then it's decreasing because you're paying it down. Maybe, I don't know. I don't know how we're not on the same page there. Yeah? It's increased, and then it decreases because you pay it down. And the way Arturo answered the question made me think that you guys thought that was, because you answered that question assuming that was a given. I just wanted to make sure that was clear. Cash debt pay down. And AJ as well. I think you guys just assumed that was a given, or maybe that was the next step. But my point is, debt changes from 2 major factors. It's incurred by interest, the obligations, and then you pay it down. Right? The debt decreases from the paydown. So my point is, we need to figure out our exit. We need to figure out how that debt's changing. So we need our EBITDA growth. We also need to know the interest. We also need to know how much cash we've generated over the 5 years. So because of that, the very first step is we need to build out a simple unlevered free cash flow. Unlevered. Just like valuation. EBIT, EBITDA, D&A, all that stuff. We can figure out unlevered. Because unlevered free cash flow gives us two important things to continue our analysis. It gives us our year 5 EBITDA that we can apply a multiple to, and it gives us the unlevered free cash flow that we can use to figure out how much debt we're paying down. So the next, once we build that, that's the bigger piece. Then B, we calculate our exit. And our exit is going to be a multiple times let's say year 5 EBITDA. Just multiply. What multiple do we use? Typically in these deals, we just take the entry multiple. We assume no multiple expansion to be conservative. It's typically what's done. Do not assume multiple expansion. Although it's a major strategy, typically do not assume that. You want to achieve your IRR hurdle and assume that even if you sell the company for the same multiple that you paid for it, you're still achieving that. So now we have our exit. We've sold the company. That's not the money that we get back. That's not our return. To get our return, we need to calculate final debt. Okay? How do we calculate final debt? Well, we start with the beginning debt. We go to beginning debts. Okay? Now we calculate the collected interest obligations over the 5 years of holding the company. So it's the debts times the interest rate, tax deductible, and 1 minus tax rate. Interest on the debts, tax deductible, times number of years. 5 times. That is the implied interest assumed. The total accumulated interest. Got it? Got to memorize that. That is the debt. The interest, sorry. This gives us total interest. Okay? Step 1. Step 2. We take the sum. Okay, I don't know why I can remember that. I used to be able to sum of unlevered free cash flow minus debts minus total interest. Okay? That's our final debt. Sorry.
Would it normally be a negative number then?
Yeah, totally back. The debts plus interest plus total interest minus sum unlevered free cash flow is you'll be left with debt. That is the final debt. That's the final debt. Then your return is the exit minus the final debt. That's how much money you get. That's it. It's an LBO. And you calculate the IRR by taking the money out. What's the money we put in?
The equity.
equity to the power of 1 over years, the Kager formula. That's your IRR. That's how you do a buyout. So, again, you want to build a little unlevered cash flow. You need a little unlevered cash flow. That gives you the capability to calculate the exit, it gives you the final EBITDA, and it gives you the ability to calculate cash, your unlevered cash flow. And then we calculate the exit. Okay? We calculate the exit by applying a multiple to the final year EBITDA. That's not our return. We need to figure out what our final debt is. So we calculate the total interest obligation incurred by the beginning debts times the rate, tax deductible times number of years, and we subtract all that from the unlevered free cash flow. That gives us the final debt. Very simple. The exit minus the final debt is our return.
What's the exponent? 1 divided by...
The number of years. It's Kager. It's the compounded annual growth rate is effectively what we're doing.
It's 1 minus 12, or number of years minus 1.
The whole thing is minus 1. The whole thing is minus 1. Just the compound annual growth rate. So, let's look at one using this format. We'll do one together, and we'll spend today and tomorrow kind of doing some on our own. Let's say we have a company we want to invest in. Okay. It's a trucking company, a delivery company. I want to know how profitable it can be after 5 years. In other words, if we invest in the business together, what would be the profitability? Okay. So the first thing I do is I note some key financials. Okay. I note the unlevered free cash flow. Okay. This is the actual EBIT, D&A, CapEx, change in capital, taxes, very simple, growing out X% for 1, 2, 3, 4, 5 years. Here's some key balance sheet line items, the assets, the liabilities, the shareholders' equity. I want to know the IRR. What's the first thing I need to know?
The sum of all the cash flows.
Before that, what's the first thing I need to know?
Purchase price?
Purchase price. And it's a private company, although unusual, just to, I want to focus not on the reality of this case, because again, with this process, first thing we want to do is get the purchase price. Let's say I'm paying a 30% premium above the stockholders' equity. We've negotiated a 30% premium above stockholders' equity. Okay? So $7,500. Okay? So the purchase price is $5,000 times 30%, or $7,500. Okay? Effectively assume no fees. Okay? $6,500. Sorry. $6,500. Now what do I need to do? They're paying $6,500. Now what?
What is the debt? Net debt?
Net debt is 1,000. Let's assume their liabilities are all, let's say, long-term debt. Be very simple. That's the net debt.
You calculate the entry multiple.
Okay. So we got uses. Purchase price is 6,500. Net debt is 1,000. Fees are 0, let's say. What's the entry multiple? How do we calculate it?
Well, a public company would be purchase price plus net debt divided by the EBITDA, but I'm not sure.
That's right. Wouldn't be different either way. So it's 7,500 divided by what? 1,020. We really don't need this right now, but I'm just going along with it. 7,500 divided by 1,020 is what? $7.35. Okay. What else do we do? What else do we do? What's the next step?
You're good. Where are you raising the debts from?
Yeah. Let's say there's 70% debt being raised. Let's keep it simple. Okay? Again, I want to avoid the specific details of the terms, just high level. 70% debt, and the rest we're going to have to put in an equity. Just $22.50. Okay? Forget about the details of how much is high yield, this and that, we're just high level. Okay? Purchase price, sources, uses. What else? Let's say the interest on the debt is 9%. 9%. What's the next step? Cash flows are given. Let's assume they're given. So right, now we calculate the cash flow. Here it is. Okay, cash flow is given. Now what?
Some 1.5.
Yeah, I mean, we could. We don't need it yet. What else?
Tax rate.
Tax rate is 35%, but we can do that. What else?
Exit value.
Exit value. What about it?
Find out the, let's say, year 2018 if you're exiting.
Yeah.
And take the beta multiple with the same 7.35.
Yeah.
So that's exit value.
Okay. So 7.35 times 1631. So 1631 times 7.35 is
11,990.
I got 11,987.9.
Yeah, you loaded them.
The exit is 11,987.9. That's the exit. But that's not what we get, right? It's not a return. Now what do we have to do?
I have the interest.
Okay, how do we find out the interest?
Debt.
The debt's raised.
That would be interest.
9%. 1 minus
Tax.
35 times 5 years. Who did that? Or who's done that? 5250 times 9% times 0.65 times 5. I got 1535.625. Yeah? Okay. Now what? Now what?
Total debt.
What do you mean?
You find out the debt.
We have the debt, 5250. We're calculating the final debt.
You add the 5250
Add 5250 to what?
to that
1535. So the total obligations is 5250 plus 1535. And what does that give us? That's how much we owe. And what do we do with that? Subtract the cash flows. So if you add up all the cash flows, you'll get 3215. If you add these up. 1, 2, 3, 4, 5. Right? Just the 5 years of cash flow. So we got the debt plus the interest in 5 years minus the cash that we have to pay. What does that give us? 5250 plus 1535 minus, that gives you 3570,625. That's the final debt. Right? What number does that mean? What does that represent?
It should be your debt balance in 5 years.
Yep, that's your debt balance in 5 years. And what do I do with that? How do I calculate my return? So we're here. Make 11,987.9 minus 3570.625. And that gives us our return, which is $8,417 and 275. Okay?
Excuse me, Paul. The first number in final debt, what is that, the beginning debt balance? Or total interest as far as final debt?
This number?
No, for final debt I, for the first one, yeah, what does this line calculate?
Total interest.
Over 5 years?
5 years of interest, yep. Okay? Now what?
%?
Hmm?
30%.
But what do you do now?
Now this is the equity value you receive,
This is the equity value returned.
right? So equity is 2250.
The equity is 2250. Yeah.
So you divide this 8417 with 2250
Yep.
to the power of 1 over.
So we want to calculate the IRR, right? That's what I'm trying to say. And then you're right. We take 8417.275 as what everyone is suggesting, divided by the money in, 2250, to the power of 1 over 5 minus 1, and you got 30%? Yeah? 30% even?
30.2.
I didn't do it. 30.
30.196 if you want to get it. Yeah.
Good.
What's a typical minimum IRR?
A lot of investors require 25%. That's what they say. They don't actually get that, but that's what they want. They won't do a deal that's less than 25%.
Projected.
Expected, projected. What are the major variables in this analysis? Start to think about what's different.
Your debt interest rate, number one, multiples.
Debt interest rate. What else? The multiple. Entry and exit multiple. What else?
How much equity you're putting in.
Yeah, the amount of equity being put in. Exactly. Right. The less equity, the higher the IRR. What else?
Cash flow.
The cash flow. So the whole unlevered cash flow buildup, the EBITDA growth, the CapEx, all that, those are major variables. What else? Two major things you didn't mention. Major variables. What about the debt? Because Devin was talking about debt a bit.
The more you take out the debt, the less equity.
Yeah, well, we just said that. Yep.
Yeah.
Yep.
How many years until your exit batteries are
Yes, time frame to exit. That's one. At 5 years, 7 years. What else? One more. Very obvious. Missed it. The thing you should have said very at the beginning. Actually, time frame was the first one. Second one. Purchase price. Maybe that's implied by the multiple. The purchase price. Higher purchase price, like an M&A, it's just more stress on the whole thing, right? It would hurt your IR. Those are the major variables. Okay, so think about those major variables when we do this paper example.